Hi everyone, my name is PK and here I have Sanjeev Kaushik, who is going to talk about the stock market. Why are we talking about the stock market on a property channel? Is the reason is that we get so many questions you guys ask all the time, whether to invest in stocks or whether to invest in property, right? And none of this is of course financial advice, but Sanjeev Kaushik is, the real deal. Last year, he made $2 million in profit through the stock market. He helps himself, his family, and he's got investors in which he works with. And he's got around 5 million, close to 5 million of funds under management, $5 million of assets under management globally, I think it is. So, who better to get on the channel to discuss the pros and cons, a bit of a debate on real estate versus the stock market investing that he does. Welcome, Sanjeev. Thanks for coming on, and I hope I did the introduction justice.
No, thanks a lot for saying the kind words, PK. Really appreciate that. And yeah, really looking forward to our conversation. I'm sure our audiences will find a lot of value from this discussion, and we will hopefully put an end to this debate of stock versus property, which asset is a better one, if at all there is one. So yeah, looking forward to it.
Cool, let's go. Let's get going. And guys, let us know if we haven't covered any pros and cons. We can always continue the conversation afterwards. But Sanjeev, my first sort of question to you, and I'll try rebut it afterwards. What's your first argument? Like, why is stock investing better than property investing?
Firstly, as a property investor myself, I can't really say that one asset is better than others. So I would say they both have their own pros and cons, which of course we will talk about them as we move forward in our discussion. So yes, you can't say they're better, but they have place in an individual or a family's investment portfolio. If you're only sticking with one asset type, maybe you're over concentrated towards it, and you might consider diversifying. So yeah, too much of everything is bad, and same goes with stocks and properties. How much of it you want to break it down into, how much into properties, how much into stocks, can often be a personal preference, as in which asset do you like more. But just steering clear from one asset type is probably not the right way of building your own wealth in future and for your offsprings.
Sure. And let me just counter that for a second, right? I can't remember what the book, maybe Atomic Habits. There's this book I read many years ago, and the truth in my own portfolio is that I have almost zero stocks. All right, so 12 properties, LVR of under 20%, valuation, total valuation around 10 million. Passive income of more than 150K now, zero stocks. So like, I'm being a little bit facetious here, so bear with me. But this whole argument of diversification, right? I subscribe to the school that you do as well, where diversification is important. But if you know one thing, right? If you know one thing and you do really good at it, and you can replicate those results, you have a tried and tested method or methodology that works and is reliable, then why not just double down? Like, it's like, when you're in early stages of high school, you learn science, mathematics, PE, all this sort of thing. And then towards grade 11, grade 12, they ask you to specialize, because then you can get really good at one thing and then enter into that course at university. So like, why not just do that? Why spread yourself so thin? Given even property is so hard to learn, stocks are so hard to learn, cryptocurrency, not that we're talking about that, is so hard to learn. Why not just do one thing and do it well?
Firstly, I 100% agree with you. If you have a strength, you should stick with it. And just like yourself, you have a knack for picking up properties which are really undervalued. And I'm sure a lot of the people who have been following your work, your clients, have done that. And there's nothing wrong with that. But let me just lay out a scenario here. And it's a real life scenario. I was speaking to this tradie, and he bought a property about 20 years ago for 150,000 somewhere in Sydney, and now that property is worth $1 million. That's the only property he has, and it's an owner occupied. He's been doing okay financially, but now, and the property is completely paid up. So you can say that he's sitting on an asset worth $1 million, and it's the only asset he has. Now, if he wants to help his kids buy properties, then the only way he can leverage upon his existing asset is either you take some kind of a loan, draw your equity from the bank, or you sell the home. Selling the house is definitely not an option. So if you are going to draw the equity, give it to your kid so that they can buy their own. It's kind of not a desired solution to this question here, because then again, you're adding on to the liability upon yourself at the age of 60, 65. Do you really want to do that? No, you don't. Instead, if that same 150,000 would have been invested in stocks, now I'm not saying that he should have done that, but let's just say, for instance, then if those stock portfolios would have been worth $1 million, he could easily sell off stocks worth $200,000 and then help his kids to get into properties. So yes, you can break down your asset to really a granular level, which may not be possible. Now, this kind of a scenario may not be applicable upon yourself and not on many others who have got multiple properties. But those who have got maybe one or two, at some stage, they will not be able to monetize it at such a granular level. So yeah, I mean, it depends. How do you think your future would be going forward? If you would have 5, 7, 10 properties and you don't mind churning your portfolio if needed at any given point in time, that's well and good. And on top of it, I don't really want to be the devil's advocate here, but one thing where I think stocks are better than property is that your holding cost after you exceed a certain level increases a lot in properties. I'm sure it would be pinching you at this stage. The land tax, you don't have a stock tax. You don't have stock tax anywhere. So you could be holding stocks worth $100 million and you're not paying a single penny to the taxman as long as you don't realize your profits. But that's not the case with properties. You will have to pay land tax. Of course, if you're lucky enough to have exceeded that threshold across the states, maybe you should be proud of that rather than complaining about it. But at the same time, I think, yes, the markets or the system is such that you're not penalized for holding stocks, but you are penalized in a way for holding too many properties. That's because maybe the system or the governments think of property as more of a necessity than an asset. But yeah, this is an advantage worth sharing here. I definitely don't want people to steer away. But the other thing that I would probably mention about the differences between property and stock market is that because stock markets are so liquid and so efficient market hypothesis, anything in the pricing of stock markets or stock is already factored in. And you would say that the current market price is the best estimate of what the stock is really worth at any given point in time. But with properties, not so much. Now, it can go in your favor if you are able to pick the properties which are undervalued.
I was just going to say that, yeah.
I'm sure that this is right up your alley. I would know that. But sometimes you might end up overpaying as well. But that's the case with stocks. But the way stocks are valued as compared to properties, I would say that the system is slightly broken in property. The valuation dislocation is much more commonly seen in properties than stocks. It's not that it's not there in stocks. Warren Buffett is a good example. He's known for picking undervalued stocks, and that's why he has got such a huge fan following. The moment the news breaks out that he has invested in so-and-so stock, that stock will shoot up by 10, 20% in a matter of a day. But not so much on property. So for picking up the undervalued properties as well as stocks, you should have skill. But if you are a skillful person, you can actually do much better in property than you can do in stocks, because valuation
You're meant to be arguing for stocks here, just as a reminder, Sanjeev. You're meant to be arguing for stocks, not property. I feel that you're doing my job for me.
I'm trying to lay out the facts here. Because I'm a stocks guy doesn't mean that I don't like the property. Maybe if I would start this 5 years ago, I would want to acquire a property or two additionally than what I have right now. But the reason I'm saying that maybe valuation dislocation is more common in properties is because of these independent valuers that the banks hire and pay them. Of course, if you're getting paid by one party, then where's the independence? But that's a matter of integrity. Let's not talk about that. If you think about it, in the entire system, the buyers, the sellers, the banks, and even the property agents, they have skin in the game, but the valuers don't really have skin in the game. So it's pretty much their own integrity and professionalism, and of course their expertise, on the basis of which the properties are valued. And this is pretty much a common practice across the globe in all the developed countries. So as long as you have someone else valuing the property, how much trust would you have in that? And that's why we have these dislocations. And that's why I'm saying sometimes you might end up overpaying, sometimes you might end up underpaying. So valuation dislocation is much more common. It can go against you as well. You may think of this as an advantage, but a layman like me who's going out in the market and buying a property, I would be much more comfortable buying a stock, because I know, based on efficient market hypothesis, that maybe stocks are much better valued than
I totally
property.
understand. I totally understand where you're coming from. The stock market, or the stock price, is what it is. It's online, it's transparent, it's liquid, it's an efficient market. But you talk to 10 different people, they'll tell you a house is worth 10 different values. And yeah, you can use it as an advantage if you truly know how to value it yourself independently, looking at comparables in a sophisticated way. Or it's a disadvantage because if you're not educated, someone can pull the wool over your eyes and you buy it for more than what it's actually worth. Now that's a definitely an advantage, I would say, for the stock market investor. Someone who's not educated in property, they will easily lose money, I would say, from that perspective. One thing, Sanjeev, I always get asked from so many people is that stock market investing requires no headache. Like, for example, property investing is like every year the air conditioning needs to be maintained, or there's like a plumbing issue or an electrical issue, or every 5 years or 10 years a hot water cylinder breaks down. There's like all these things. A retaining wall needs upkeep, landscaping. Whereas in the stock market, there are none of these headaches. Like, that is, do you see that as an advantage of stock market investing?
It's a really great point, but we human beings are really complicated. We try to take the headache. The current scenario, for instance, people are just glued. As we speak, there's going to be a FOMC meeting and they're going to announce the interest rates. I'm sure you're also tracking the development. People are just glued to what is going to happen. We often overlook the bigger picture. So yes, you're right. There's definitely less headache in stocks. But then we end up taking a lot of headache, and that's why I tell people it's not worth it. The stock market is not economy. So do not worry too much about the economy. But yes, I agree with you that it shouldn't really be that painful. It shouldn't really be that much prone to anxiety. But people often try to take just as much stress in stocks as they do in property, which they shouldn't. If you are more of a invest and hold and then forget about it kind of a person, you'll do really well in both the assets. But if you are an active investor or an active trader, a little bit of anxiety is really a part of the game. The only benefit is that you don't have to deal with other people. Your portfolio, your profits and losses are your problem. Whereas in properties, it's different. If anything is happening, it's bound to be someone else's problem as well alongside, but somehow it all boils down upon you. Anything is breaking down, you have to take a decision. The pool is not compliant enough. Small things, yes, they do give you a lot of headache. But I think if you look at the bigger picture, again, regardless of which kind of asset it is, you would realize that you're not really playing a short-term game over here. In the bigger picture, none of these things matter. The interest rates don't really matter that much. What the governments are saying, what the central banks heads are saying, or whatever is happening with our tenants, how many weeks or days our property has been vacant. In a long run, none of this matter. Just like if stocks are moving on the basis of their earnings and news, in a long run, if the fundamentals are right, and if you are investing in an asset that is not only driven by fundamentals, but is also having right fundamentals beneath it, then you shouldn't really be worried about it. Now, PK, I do want your response on this question, because I know that when it comes to acquiring the asset, one of the additional costs associated with properties is the stamp duty that you pay. And a lot of people don't realize that, but when they sell their property, they end up throwing away the stamp duty. And as if you're a savvy investor, you would always take that into consideration when you consider selling your property. However, when you're buying a stock, the cost of acquisition is virtually zero. And we also spoke about the holding cost of stock being zero. So what do you say to this additional expense while acquiring property? Something that you cannot get rid of even if you tried.
Yeah, I mean, this is such a good point, and there's no doubt that transaction costs in Australian real estate buying and selling are like really painful, and so it's really difficult to be a developer or a renovator in that context. However, two things that I'd say is that stamp duty, yes, if you're buying and selling, you've wasted that money in essence, right? Like when you've sold that property, it's kind of that there's no value added to your assets, vanished. But I think sophisticated, long-term property investors, as opposed to speculators, those who are holding the asset for a long period of time, they're mostly doing it so that in 10 years, 15 years, 20 years, they can, pay down their debt, their rent increases, they're going to create some passive income, right? And so it's also going to become generational wealth. They're going to hand it down to their kids, etc. So they're actually, I think most property investors, they don't actually sell their investment properties. And in fact, the people who do sell their property, I think that's like the number one regret of a property investor. I sold that property, had I held on to it, I mean, that it's going to be worth $1 million, or 2 million. I sold it when it was 500,000 or $1 million. So buying and selling property in Australia is, generally speaking, not a great idea unless you know what you're doing. So that kind of makes that point that you've just raised, a good point, somewhat moot. And the other point as well is that there is some states, for example, ACT for residential property and South Australia for commercial property, where stamp duty has been abolished. And so that kind of theme is also pervading into New South Wales now. It might go into Queensland, other states. So I see that in maybe 2 years, 3 years' time, we might be in a position where across all states and territories in Australia, there is no stamp duty, therefore reducing that friction. All of a sudden, properties, are becoming that much more affordable because there's no additional one-off costs, and that will drive a bit of a pressure on prices upwards. Of course, it's a bit like that saying, robbing Peter to pay Paul, because the government still wins at the end of the day. The casino always wins. They're going to charge you land tax. Your point before, stocks are free to hold. Properties, there's lots of incumbent expenses and costs and taxes. That's a reality. So I think there's no arguing that point. But yeah, if 2 years, 3 years stamp duty is abolished, then yeah, problem solved.
Fingers crossed.
One thing that I thought of as I was answering that question, if you don't mind, Sanjeev, as well, is back to this concept of long-term returns. Long-term returns, correct me if I'm wrong, but I think that in Australia, well, I know that in Australia, over the last 35 years, real estate performs at about 6.5% compounding annual growth rate per annum. And I think the stock market performs, call it ASX 200, 300, whatever it is, around 6 or 7% as well, or thereabouts. So my argument on the side of property is that, great, regardless of what you invest in, you're making the same amount of money long term. However, in the real estate market, you're able to leverage, right? So you're able to leverage 80% or sometimes 90% or more, depending on your risk appetite. And so therefore, you're able to generate higher cash on cash returns, right? You're able to have multiple assets using the power of good debt, deductible debt. And therefore, in 10 years, 20 years, you're so far ahead, starting off at like $100,000, you're so far ahead of your friend who invested $100,000 into the stock market. And I know that you can get a margin loan, and I know that you can lever up in the stock market as well, but it's seldom that a bank will allow you to get an 80% LVR or a 90% LVR, because even they know that the inherent risks in the stock market, there's more volatility, right? So, I mean, what would be your thoughts on that?
Oh, I think you pretty much partially answered. Yes, you can leverage in stocks, but it's more for sophisticated market participants. You can't just go out and buy options just because you know about them. Because unlike in properties, where your original investment will go nowhere, you can definitely lose all your money if you try to go ahead with leverage. And many brokers, in terms of stock investments, explicitly ask the investors, if you're bringing in a huge pile of cash, they would want you to confirm whether this is borrowed money or your own money. And you will have to actually disclose it to the broker. So yes, I mean, when it comes to leverage, it's not available to everyone in stock market, it's to some. Whereas, yes, it is a good point that leverage is a big benefit that is available in property markets. And let's, for instance, and I'll probably be speaking in your favor here, although it's more of a debate than an argument, but when you compare exclusively the Australian property with the Australian stocks have actually underperformed property by a huge margin. The highs in ASX 200 that we saw in just before the global financial crisis of 2008-9, only in 2019, if I'm not mistaken, we were able to go back to that level. If you compare the ASX 200 with other stock markets, they actually were trading much higher than those levels, starting from 2013-14. But ASX 200, after this huge underperformance, for not just Australian properties, but also the rest of the stock markets, started outperforming just a bit until the COVID-led sell-off happened, and then everything again crashed. So yes, it makes a very strong argument in favor of investing in properties, especially in Australia. You see, the fundamentals for Australia are really strong, and they will remain strong. And I'm not really talking about the supply-demand mismatch. Yes, that is there. But the main driver of this mismatch is the inorganic growth in population in Australia. They can open their gates, and then immigrants, and that's a quality immigration, by the way. People who come in here are ready with a job, ready to pay taxes to ATO. A child, as much as we love them, is actually a liability on the government, and also on the parents. And it's only until 20-25 years when they start becoming an asset to the society. But if you can have this kind of an inorganic growth, 190,000 immigrants coming in just this year, you can actually grow the productivity in your country. You can increase your GDP a whole lot. You can actually have meaningful growth in people's income and assets by doing so. So that's why I think that's the fundamental driver, and that's the reason why the Australian property has been outperforming. And you and I shouldn't have any doubt about the outperformance of properties in Australia to continue. And as a matter of fact, I myself, even though I'm a stocks guy, have much more exposure when I compare with Australian stocks and properties. I don't have much of an exposure to Australian stocks as compared to Australian properties. Even in terms of my own cash put on the table for acquiring those assets, it is going to perform really well. And any country that is embracing immigration, Canada is a good example. And by the way, if you compare with Canadian properties, I think the Australian properties have much more headroom to grow from here as well. And if you really want a proof of this point, then look at Hong Kong, where reverse immigration is happening. So their property pretty much have been either stagnated or going down. So if the quality of people living in your country starts going down, then the properties would also come down. So yes, I mean, I do get this point, and I do understand the reason for the Australians to be so bullish and so much exposed to Australia, to the property market, and they've done it rightly. I think their call, in hindsight, have been the right call, and it will be right call in future as well.
Sure.
But one thing I think, now that I have you as an expert on property, and one challenge that people often face is when to sell. It is so much common because it's so easy to get in and get out of stocks as compared to properties. People don't know how long they should be holding their stocks. What's the right time to actually book their profits? And those who could not book the profits at the recent peaks of stock markets might be able to relate to this point. So what do you think is the right time for someone to get out of their properties, if at all they want to? Are you from that camp where you say, never sell, keep it for your offsprings? Or do you think that there is definitely a right time which when an investor would actually consider taking the profits off and then probably enjoying life if they want to?
Yeah, sure. Such a good question, because in the stock market, there's this concept of market has gone up, or my stock, particular stock price has gone up. Let's cash in the profits before it falls again. You know, that kind of thought process. In the property market, I feel that a lot of stock investors who start investing in property, they bring this similar mindset over, where it's like, okay, I've made money, now it's time to cash in the profits. But really, the property market, it is a very expensive asset to keep buying and selling, buying and selling. Transaction costs, like I said before, are very big. One thing that people don't realize in the property market is the potential for passive income. Traditionally, let's say you're in Sydney or Melbourne, you're like, oh, I made $200,000, $300,000 in the last couple of years. Let's take that cash out. Let's take that money, do something with it. When you sell, you have to pay capital gains tax, agent fees, conveyancing fees, etc., etc. You don't have, of course, you have capital gains tax, but you don't have all these additional fees when you sell in the stock market. But why not hold that property, right? And this is one thing that people fully don't understand. If you hold that property, you've got equity. You can refinance. Once again, it's a difference in the stock market. You refinance that house, so it's gone up 300,000, take 200,000 out. That becomes a deposit for another 1 or 2, maybe even 3 properties elsewhere. So there is no need to pay the government capital gains tax. There's no need to incur those transaction costs if you're looking to expand your portfolio. And that way you can diversify. You can say, all right, I have one in Melbourne. I think over the next couple of years, Melbourne will soften out. I can refinance, take the equity, and now buy in Perth or buy in somewhere else. So I'm of this opinion that whether or not it's a generational play, it makes sense to refinance as a first option as opposed to sell. And if you are selling, you should only sell when you need to sell. So let's say you've exhausted your borrowing capacity, you've exhausted your savings, you can't buy any more property, then you might look at your portfolio and see, okay, I have 2 or 3 or 4 properties, which is the most underperforming one, and how can I better allocate those assets elsewhere, whether it's in the stock market or anywhere else. But ask yourself, can I better allocate them? Because by selling and then just having that fund in your bank account or an offset account for a year, 2 years, 3 years, I mean, inflation is just going to erode that away. So you need to have a quick plan of attack of what you're going to do with it.
And one thing that I've always been fascinated about is Japan's property market. And I'll tell you the reason why I'm raising this point here. You see, back in the 80s, during the heydays of Japan, this is what actually makes me wonder where there is, if at all there is, where would be the ceiling when it comes to Australian property? Because back in 80s, if I'm not mistaken about the timeline, in terms of geographical size, US is 25 times bigger than Japan. But back in 80s, the property price in Japan were 5 times, as in the entire real estate was valued 5 times greater than the entire real estate value of the US. So that's how overvalued Japan was. Do you see this kind of a risk happening? And by the way, the Japanese property markets have still not recovered even after 30 years. Do you ever see this kind of a risk in Australian market, although we both have been very bullish on the fundamentals? But do you think that 30, 40, 50 years down the line, maybe the price at which the property is selling at that time would be pretty much same or lower than what they are selling right now?
This is a great question. And I might ask you the same of the property market in a second, of the stock market in a second. But let's kind of bring it back to like 5-year outlook or 10-year outlook. Who knows what's going to happen in 50 years, right? I think one fundamental thing, which is a challenge for Australia, is that although it's a large landmass, the density of population or where people live is really only some select areas. Yeah. And the way that zoning works in Australia and the way that the topography or the terrain is situated is that you can't always continue to build out, further and further away from a capital city. For example, in Sydney, you're flanked by the Blue Mountains. You've got the ocean on this side, you've got the Blue Mountains on that side. So you can't continue building out that way. And we're already built almost all the way out to Newcastle, right? And on the south side to Wollongong. So, and people need to live. They want to live close to the job center. Okay. So the problem is that in Australia, there is a scarcity of land, which seems preposterous because we have such a big country, but where people want to live, there's a scarcity of land, and there's not this concept of units or high-rise living, which there is in Japan and other places like Hong Kong and things like that. Because of this reason, and it's not just in capital cities, it's also, I'll take an example of the Gold Coast, a secondary city or a regional center. You've got the ocean on one side, mountains on the other side. Down south towards Byron Bay, it gets very, very expensive. There's no more land really to build out so much. On the north side, it's almost fully developed now through to Brisbane. So where else are you going to develop? Gold Coast property prices in 10, 20, 30 years time can only go up because it's the land that holds the value, and they're not making any more of that land. And Australians and migrants into Australia still, up until this day, they want to buy land. They want to buy either a townhouse or a house, a piece of dirt that they can call their own. And so just with that scarcity principle, I see it. I just don't see property prices going down in the long term. Yes, you've alluded to this, that GDP or debt to GDP in Australia is the second highest in the world. So we're a highly indebted nation, especially in our residential property. But you can also say that our wealth, actually statistics just came out from Credit Suisse yesterday, we are the wealthiest nation in the world, right? On a per capita basis. We're a lucky country. So yes, debt is high, so is wealth, scarcity of land where people want to live. Now, the only thing that may change this as a kind of curveball is if we get very, very high-speed rail that connects our regional centers, Bendigos, Ballarat, Sunshine Coast, Toowoomba's, etc., to our capital city, so then people can live regionally and commute to work. If that happens, then I think that property growth story is probably not there. But that requires $50, $100, $200 billion of infrastructure, where it's talked about for the last 20 years. It's probably never going to happen.
Oh, thanks. Thanks for for putting my mind at ease that Australian property will go up, at least for a decent period of time, really. Because the Japanification of be it properties or stock markets is always the scariest point for any investor. So yeah, I can't imagine something like this happening with our portfolios, our stock investments. That will probably wreak havoc for those who are looking to invest.
And can I ask you that same question as well, Sanjeev? Back when I was at university, I always wanted to become an investment banker, which I did. At university, I watched this movie called Wall Street. It was the first Wall Street, and there was this one of the principles from that movie was that stock traders, they don't add any value to the economy. They simply trade, buy and sell intangible, immaterial secondary assets. You're not actually contributing towards jobs. You're not adding value to the economy, unlike property investors. And everyone hates landlords, right? But we provide rental houses, and we know there's a rental crisis, not enough houses in Australia right now. So my question to you is, the stock market has come a long way, especially since fiat currency, et cetera, and then quantitative easing. To what extent is the stock market, because I think this is what scares people, to what extent is the stock market, whether it's Australian or Nifty or S&P or NASDAQ, to what extent is it just pure speculation? Or to what extent does it have some link to the real economy? And if it has a link to the real economy, is it overpriced, price earnings ratios too much? What's your thoughts on that sort of topic?
I think in a short term, the traders are no better than the mob, and they're all reckless and speculative. But in a long run, yes, the fundamentals do matter. The PEs matter. The economy matters. The Japan stock markets have only recently started exceeding the highs from 80s. So fundamentally, I believe if you ever want to invest internationally, right now, Japan is the country to invest. No buy or sell advice, by the way. But yes, coming back to your point of how much value these traders or investors add and how much stock markets stay connected with the economy, I would say if you look at the economy too much, if you read the news too much, you would never be able to invest with a lot of confidence. Same with the property market. If you would always read about the news of 30% crash, you will wait for that crash and you would never be able to put your money to work. It's the same way. Yes, they are interconnected, but not as much as the media makes us believe that they are. So in a long run, I think these still are the safe investments. They have been for past couple of 100 years, if not longer than that. And I believe they will be.
I completely agree with that. I saw the statistics, this table, which I shared in another video, where in the last 10 recessions globally, including the Great Depression in the 20s and early 30s, the stock market outperformed, it went up even through the recession. I think it was 80% of the time. And the stock market bottomed 6 months before the recession bottomed. So like if people think, oh, you know, like right now, price earnings multiples are too high, stock market looks very heavy, top heavy, seems very overpriced, especially the tech sector or whatever, you know, if you're waiting for the economy to improve and then getting into the market, you're normally a little bit too late. The stock market sometimes preempts what's going to happen in the real economy. And I feel that the real estate market is a little bit the opposite. Once the real economy starts to go down, the real estate market goes down. And once the real economy starts to improve, then there's a lag effect. The real estate market starts to impact. So there are two different asset classes, two different timings.
Yeah, no, I 100% agree. And you can look at what stock markets are doing right now. The unemployment is at all-time low in many countries. In Australia and in US, we are at 40, 50 years low. And still the markets are 10, 15, 20% down from the top. So they're kind of factoring in. It's like a statistical model. The markets are nothing but a statistical model. A new information, new variable comes in, they try to crunch in the numbers again, and then collectively the entire market decides this is the value where we want to trade at today. If the things are going to get better, 1 year from now onwards, people are smart enough to start putting their money to work right now. Those who were really good at it were already exiting back in December and January. And right now, I believe next 3 months are going to be difficult. But beyond that, you can't keep good assets undervalued for a long period of time. Liquidity is still ample. It would still be sufficient enough to keep these kind of valuations afloat. Yes, there is no infinity when it comes to the money supply, but we are pretty close to that. The abundance is still there. And even with QT or Fed tightening or the interest rates going up, people are still wealthy. And where else are they going to invest? In bonds with 3-4% interest rates? Maybe not so much. Yeah, so
that's
stocks
a really
and
good point. There's no, if you don't want to buy property, you don't want to buy stocks because you think everything's too overpriced, where are you going to put the funds? And there's so much money on the sidelines right now. It has to be deployed somewhere because fixed income, bonds, etc., just doesn't give a sufficiently high rate of return. One thing I think we can agree on is that whether it's a stock market or a property market, it's not really a question of should I buy or should I not buy, or should I sell or should I hold? The question is, within the stock market, which stocks are you talking about? There's always stocks that we should be staying clear of right now, buying right now, or holding right now. The same thing in property. It's not one big market. There's 15,000 suburbs or like 15,000 stocks in the property market, 15,000 suburbs. So, you know, there's always suburbs that I wouldn't touch with a 10-foot pole right now. And there's suburbs right now that it's so hot, like, you know, it's hard to buy. It's booming. So I think that's a one misnomer people don't fully understand. It's not really a question of the asset class, but markets within markets and stocks within stocks. Do you guys agree?
Yeah, I 100% agree with you on that. There's always a bull market and always a bear market, regardless of which asset class you look at. If you are looking at the smaller pockets, you can always find the buying opportunities or even shorting opportunities when the markets are at, let's say, still the bottom. You can still sell the stocks that are never going to perform just like they did. So yes, it is an asset pickers market collectively, both stocks as well as properties. We are still, for my clients, I'm still picking up stocks. We are still 80% invested with our capital. And I also know people who are sitting on a huge pile of cash to put in So it's a matter of picking up the right stocks. We took an example of ASX 200 only exceeding its pre-GFC levels in 2019. It doesn't mean that stocks were not doubling or tripling from the low levels. Yes, they did. But it's an asset pickers market. And if you're really good at it, you can do very well. You can beat the markets. You can beat the rest of the investors. But if you're not really good at it, doesn't mean that the game is over for you. You can still buy and hold. And this strategy has also worked. If it has worked for Warren Buffett over the last 60, 70 years, there's no reason it wouldn't work for someone else who has probably been investing for 5, 10, 20 years with a longer duration in mind.
Yeah. And I think, everyone knows this, but just to remind everyone that there's no substitute for education. No one should buy or sell a stock or a property or in a suburb just because some YouTube person like Sanjeev or myself or someone's put it in a blog or a forum, a Facebook group, podcast. There's no substitute for true education. That's where the conviction, the confidence, and the results come from. Sanjeev, just before we wrap this up, is there any sort of advice that you can give to people perhaps on my channel who are already property investors, but they may have like $20,000, $30,000, not quite enough to buy the next property, and they want to invest it in the stock market? What's like the first 1 or 2 things they should be doing right now?
Well, they can do a couple of things. If they want to invest like sophisticated investors, then by all means, they can go on my website. They can fill a mentorship call form, and then I can speak to them one-on-one. However, if they want to do it all by themselves, then one thing that I have been telling people who have been trying to speak to me about this market downturn, what they should do, I told them, like, look, either you can bet on stock market as a whole, or you can bet on individual stocks. This is not the time to bet on individual stocks. If you're buying S&P 500 index, you're actually betting on US. Unless you believe that the US itself is falling, this is the right time to start investing in these ETFs. As the markets drop by another 2, 3, 4%, try to put in more money. So if you buy this, let's say S&P 500 index ETF in a staggered manner, then even if the stock markets were to recover tomorrow, you will feel that you have skin in the game. You'll feel good about it. You won't feel left out. And if the markets dropped, you will have another opportunity to buy more of the same asset at a lower price. So either way, you win. If you have a longer term horizon in mind, then definitely you should consider putting your money to work. I do believe that this is the right time. Nobody can pick the bottom. Don't even try. We can't pick bottom. We can't pick the peaks to sell. So the best you can do is make sure that you're not sitting on cash, because right now cash is literally trash with so high inflation, unless of course you are owning US dollars, which has been an outperforming currency and is up 15-20% since the beginning of the year. So that's the only asset that has been performing. Everything else, look at Japanese yen, it's been beaten down. All the commodities, properties, US dollar has outperformed all the other asset types, but its outperformance will also come to an end. So if you have US dollars, put it to work.
Yeah, no, 100%. Cash is trash. I like that. In a high inflation environment, assets appreciate alongside inflation. They contribute towards inflation as well. If you're very low risk, you can deploy strategies like dollar cost averaging. No one can pick the market perfectly, but if you have a little bit more risk appetite, there are more advanced ways to invest in the stock market. And I'll put a link to Sanjeev's YouTube channel, a growing YouTube channel, where he talks about technical trading and many other really fascinating things that sometimes go over my head, in the description below. Go check that out, guys. And lastly, from me, I don't think there is any winner in this debate. I truly think that whether you invest in stocks or the property market, it comes down to your own risk appetite, what you're good at, what you vibe with. Like, I don't invest so much in stocks because I don't like to constantly think about my assets. Right, I just want some peace of mind. But once again, you might love that, or you might be someone who doesn't mind constantly thinking about your, highs and lows. Goes up 20% one day, down 5% next day. Everyone's different, and I think the best or most important advice that I can get is become educated. Don't just outsource this with no education. Get educated, and that's really what Sanjeev is all about as well on his YouTube channel. Just giving so much free I wouldn't say advice, but free mentorship almost. So go check it out. My name's PK, guys. If you did get value from this video, hit the subscribe button, give it a thumbs up, turn the notification bell on. And if you have questions for either Sanjeev on not property, well, you can ask property as well, on stocks or property for me, leave it in the comments and we'll try to sort of engage and answer those questions. He's actually super awesome at engaging with his community, which is growing very, very rapidly. Sanjeev, thank you so much for your time.
Thanks a lot, PK. I thoroughly enjoyed our conversation and we should look forward to doing it more often.
Okay, till next time.